What's up everyone? Have you been dabbling in the stock market for the first time and pretending you know what's going on when you talk to your friends and coworkers? We've all been there, right? Well, let's learn the basics of candlestick charts, SMAs, and Fibonacci retracements to start building your knowledge so that you can make better swing trades or find better entry points on your long holds. Let's jump in. Let's start with the basics, and that's going to be setting up whatever broker platform that you're using. A lot of times brokers don't have charts set to represent candlesticks, so the first thing you're going to want to change is that format. This is different for each broker's platform, so changing this will be different for everyone. If you're using Webull, it's this icon right here. Now that you have it changed, how do you read this and what is it good for? Well, candlesticks give a lot of information at a quick glance, which is why they can be really useful. There are also patterns that might signify certain things, but I'm not going to get into those in this video. Anyway, here's a candlestick. Now, go like the video and subscribe. We're done here. Here's the candlesticks I'm actually talking about. But before I talk about its parts, it's good to know that a candle represents a specific amount of time that you determine within the platform that you're using. I usually have it set so each candle represents one day when I'm looking for long-term trends and support and resistance levels, but that's just me. So why do people like candles more than regular lines? Simple. A candle gives you 4 pieces of information and a line chart just gives you 1. So let's break this down. Let's look at the green candle first. So this is the body of the candle, between here and here. The body tells you where the stock opened for that time frame and where it closed for that time frame. If the candle is green like this one, that means the open was down here and the close was up here. Now there are also 2 other lines on each candle. These are called shadows or wicks. These indicate the high and the low for the time frame for that candle. So at one point during this time frame, the stock was trading all the way up here and all the way down here. The only difference between green and red candles is determining where the open and close were. If the candle is red, that means the stock opened up here and then closed down here. The wicks between green and red candles always indicate the highs and lows during that candle. That never changes between green and red ones. So remember, if it's green, that means the open price was lower than the close price, and if it's red, that means the open price is higher than the close price. The wicks always tell you the high and the low for the stock while the candle was being formed. Now that we have that down, let's move on to SMAs, also labeled just MA by some brokers. This stands for Simple Moving Average, and it means just what it says. These are moving averages of a stock price over a specific amount of time. Using a 200-day SMA might show a line that is angled up, meaning in general, over the last 200 days of trading, that stock is in an uptrend. If the line is angled down, it means the opposite. Sometimes you might see a line that is flat. That means the stock is trading consistently within the same range for that given time period. Just like candles, SMAs will have a time frame. There is no formula for what time frame you should use, but I started out using some common ones, which are 50, 100, and 200 day. Time frame can matter since the 200 day may show an uptrend in the long term, but a 20 day could show a downtrend in the short term. One common way these moving averages are used is to signify support and resistance levels for a stock. What I mean by this is that you may see a pattern of a stock price trading below a moving average and continually bouncing off of the average, but not being able to break over it. On the other hand, you might see a stock trading above its moving average and continually bouncing off the average, but not falling below it. There are some trading strategies revolving around short-term averages crossing over long-term averages. When a short-term average crosses above a long-term average like this, it's called a golden cross and could indicate the trend is shifting upwards. On the other hand, you get what is called a death cross if a short-term average crosses below a long-term average like this. It could indicate the trend is about to shift down. It is important to note that moving averages are based on historical data and will not tell you what the future will hold. Sometimes the market seems to adhere to the rules of its moving averages, and sometimes it looks like it doesn't care at all. Now let's take a quick look at Fibonacci retracement. This can usually be found in the drawing tools for most brokers. You'll have to draw this yourself, and if done incorrectly, will do you absolutely no good or could be really detrimental to your trades. Don't freak out though, they really aren't that hard to draw. So what is a Fibonacci retracement and where did it come from anyways? This retracement level stems from the Fibonacci sequence, also known as the golden ratio, which originated back in the 13th century, so it's nothing new. This sequence is pretty much everywhere, including body proportions, art, architecture, and even the layout of seeds in sunflowers. I could nerd out on this for days, but let's move on to how to use it in finance. A fib retracement when drawn can show you static points of support and resistance. Unlike a moving average that changes based on the price constantly moving up and down, fib retracement lines don't move unless you redraw the data they are based upon. A trader will connect 2 points that they find significant. Typically, this is a high and a low of a major trend that is formed. Think back to our candlesticks to determine your high and low. They're the wicks, not the body of the candle. If the trend is moving down, you will select your high as the first point and your low as the second point. If it's moving up, start with your low and end with it at your high of the trend. With that one trend line drawn, there are now 5 other lines between your high and low. These are numbers within the Fibonacci sequence based on the start point and the end point of your original line. When drawing a retracement after a significant price movement, you can sometimes see the new support and resistance levels either at or near your fib lines. These can be used by the trader to determine where to set stop losses, place limit orders, or determine entry for swing trades. If a stock is consolidating around a particular fib and is currently in an uptrend holding above its moving average, it might signal that the stock will soon break out to the next fib, which you could use as your signal to sell, since that could be the next point of resistance. There are quite a few strategies around this tool, and like any strategy in the stock market, they won't have a 100% win rate. So don't expect one, and if someone offers you a 100% win rate, you should probably just run the other way. Remember, it's also important to use more than one indicator when doing technical analysis. You should never be relying on just one. These tools can help you form your own opinions about where a stock is headed and can help you capitalize on market trends, but they won't tell you the future. Always remember that. I hope you guys learned something from this video so you can apply it to your next analysis on the next stock market play. Please like this video if it helped you at all, and drop a comment with some of your favorite tools to use for technical analysis down below. If you're looking for a brokerage account, use my referral link to Webull in the description so you can get some free stocks when you open an account and deposit your first $100. Follow the link in the description to the Personify website so you can sign up to test our social investing app, or sign up for our newsletter to get stock market plays from our team twice a week. Also, make sure to join our Facebook page down in the description so that you can join the 20,000 other people sharing and helping each other in the markets. Thanks for watching, everyone, and take care.